Hey everyone, Taiwan Semiconductor had a difficult year in 2023 as oversupply in the industry from leftover inventory crimped customer demand. However, management thinks 2024 is looking to be much better than 2023. So I thought I'd discuss the details in this video here. Let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the company's CFO said that looking to 2024, on the plus side, they expect their utilization rate to rise in 2024 as our business recovers, right? I mentioned already 2023 was a difficult year for TSM. 2024 is shaping to be a better year, and utilization rate refers to the manufacturing capacity and how much of it is used. If you're using up a small portion or a smaller portion of your manufacturing capacity, that's an opportunity lost because you've already got the capacity there. If you utilize more of it, that's beneficial to the business. Utilizing close to 100% is almost impossible for most companies. A rule of thumb is that if you're utilizing about 80% of your capacity, that's the sweet spot. That's the spot you're getting the maximum output at the lowest average cost, let's just say. So anything above that, you're starting to reach higher costs, and anything below that, you're not maximizing the output. So roughly 80% is the sweet spot. And TSM looks to be doing better or expected to do better in 2024. Of course, N3, the 3 nanometer technology, is expected to dilute their gross margin by about 3 or 4 percentage points in the full year 2024, as the revenue contribution from this next generation technology will be much higher than in 2023. This is the latest gen technology, and remember, the company invested in N2, 2 nanometer technology that's going to be coming out sometime in 2025. The CFO goes on to say that longer term, a gross profit margin of 53% or even higher is possible. So for 2024, gross profit margin will remain relatively flat, maybe down 1 or 2 percentage points because of the impact of that next generation technology and its lower gross profit margin as it ramps up. But longer term, the company feels a gross profit margin of 53% is possible. That would be a really strong gross profit margin for a company that is hardware manufacturing, right? You see these kinds of gross profit margins. Well, software companies can earn gross profit margins in the 70s, 80% range. But for manufacturing companies, for hardware companies, a gross profit margin of 50, anything above 50% is looking at really, really strong, and 60 and above is elite level gross profit margin. So in 2023, the company spent $30.4 billion on capital expenditure, a little bit lower than the $32 billion they had thought they were going to spend on capital expenditure. For 2024, they expect to spend roughly the same as they did in 2023 on CapEx. They give a range of between 28 billion and 32 billion, so at the midpoint of 30 billion would be roughly where they were in 2023. One of the areas that TSM is investing in is geographic expansion. They're trying to increase their manufacturing footprint outside of Taiwan just to reduce the geopolitical risk and also to take advantage of incentives from governments worldwide looking to bring and onshore some manufacturing to their country. And so they're capitalizing on that. In the US in particular, they're looking to add a manufacturing facility in Arizona. They've been working with the US government, trying to get their incentives and all of that in line. Now, management did say it's going to be a little bit more expensive to have manufacturing outside of Taiwan, but they feel the proximity to their customers and the decreasing geopolitical risk, right, diversifying away from Taiwan, those factors more than offset the slightly higher cost of manufacturing outside of Taiwan. So at TSM, a higher level of capital expenditure is always correlated with higher growth opportunities in the following years. That was hard to say. In the past few years, we have sharply increased our CapEx spending in preparation to capture or harvest growth opportunities from the personal computers, artificial intelligence, and 5G megatrends. And they've done a great job of that, right? TSM has put themselves on the leading edge, on the cutting edge of this semiconductor technology, and they supply some of the world's strongest AI companies, including NVIDIA, AMD. And so they've done a great job in putting themselves in position to capitalize on these opportunities. And they continue to spend aggressively, right? $30 billion in capital expenditure. That's a lot of money being allocated to increasing your capacity, making sure that it's the latest generation technology, investing in research and development, and that gives benefits for future years. In fact, despite a challenging 2023, TSM feels their revenue remains well on track to grow between 15% and 20% compound annual growth over the next several years in US dollar terms. That's a really strong growth rate as well. You've got a company here generating operating profit margins north of 40% and forecasting close to 20% growth over the next several years. So they've got really strong prospects, and it's no wonder why I've recommended Taiwan Semiconductor stock as a buy. Now the stock price hasn't exploded the way that other semiconductor stocks may have, or the way that Nvidia may have. And one of the main reasons is that geopolitical risk I mentioned earlier. Still, the company performance wise is really strong. This might be one where investors need to not rely on the valuation increasing or the market realizing the value increase, but investing in Taiwan Semiconductor and waiting for the long term as the company generates these strong levels of cash flow and profitability. And then the company itself will return capital to shareholders through dividends and share buybacks, and thereby giving investors that return on investment. Even if the market still is hesitant about TSM stock, the company organically will earn those profits and cash flow and return that capital to shareholders over the long term. So I still have this stock rated as a buy. It's been rated as a buy according to my ratings for some time now. So this isn't a new rating or an upgrade. It's just continuation of my previous rating where I had recommended the stock as a buy. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.